What's going on, guys? Look, you're here for one thing, and that is the market direction. So I'm going to go over the overall market direction on the S&P 500, and then we're going to do my favorite thing to do, and that's read this, your stock market Bible. And that is How to Make Money in Stocks by William O'Neill. Today, we will be covering Chapter 9, Market Direction. And I think it's a good topic because where we are at today in the overall market. So if you are here for the market direction, stay for the reading on the market direction in Chapter 9, page 199 in the best stock book to ever be written. So first and foremost, the S&P 500 had a humongous pullback from the highs. It was well over that 20%. It was 21.24%, which is a characterization of a bear market. But, and I must say but, we had a beautiful pop here due to the tariff pause for the next 90 days, which obviously we are a headline news driven market right now. It's very, very touchy. It's very sensitive. Now, we were expecting a bounce somewhere down here because of the oversold conditions. Now we are ripping back up, but we aren't overbought in this area. So what I would love to see, what I think the best thing in the overall market direction that we want to see is some sideways action. Because if we just rip tater chip to the north side and then we come back down, we're going to probably come down just as hard as we went up. Just like this. We head down fast, we're ripping back up fast. What I would like to see is us head back down here because we are at an area of resistance, and if we can pull back and create a new higher low, that would be constructive for the overall market. So in this point in time, market direction, short term is down. Obviously, long term is up, and it generally is until you get one of these lower highs here. But right now, short term, mid term, we are in a downtrending market, long term uptrending, and we need more time. We are going to need more time. This is a rally right here. Now we need to see a follow-through day. This volatility we had is going to be hard to beat, so we're going to need a follow-through day. What's going on, Norm? It's good to see you, homie. So that is my focus on this. We know we're below declining moving averages, so we are risk off in the overall market until we see a follow-through day. But the rally day tells me it is time, ladies and gentlemen, to look for the leaders, the hot sectors, and the most volatile themes in the overall stock market. And what are those? Right now, they're going to start to shape. They're going to start to form. Now, if we break down and we head lower, that's going to be a change in sentiment. You'll notice that I'm going to change my direction, change my mood. But as of right now, we have hope. We have a rally day, and we have some significant pressure that's been lifted off this overall market. So we're going to look for those leaders. But of course, knowing and identifying the market direction, that's what I like to do first. That is one of many criteriums in the Can Slim or How to Make Money in Stocks, William O'Neill style type momentum trading. So I always like to study. So while we're hands off, while we're below these declining moving averages, do me a favor, put on those earbuds, put on those listening, those thinking caps, and let's dive deep into this. So again, it's page 199. And guys, if you love any of what I am doing here, make sure you hit that like and subscribe if you're watching this at a later time. But the guys that are in this Discord right now, big shout out to you guys, Jimmy Norm, B. Stewie, Title Zamora. You guys are the real ones. You're here quite often, honestly. We got one new face, but other than that, we have a really strong group here. You guys are all dedicated to learning, to getting better each and every day. So thank you for being here with me, because it sucks doing this alone. So thank you guys. Shout out to you. So this is Chapter 9, page 199, and How to Make Money in Stocks. M is for market direction and how you can determine it. You can be right about every one of the factors in the last 6 chapters, but if you're wrong about the direction of the general market and that direction is down, 3 out of 4 of your stocks will plummet along with the market averages, and you will certainly lose money big time, as many people did in 2000 and again in 2008. Therefore, in your anecdotal toolkit, you absolutely must have a proven, reliable method to accurately determine whether you're in a bull, uptrending market, or a bear, downtrending market. very few investors or stockbrokers have such an essential tool. Many investors depend on someone else to help them with their investments. Do these other advisors or helpers have a sound set of rules to determine when the general market is starting to get into trouble? That's not enough. However, if you're in a bull market, you need to know whether it's in the early stage or the late stage. And more importantly, you need to know what the market is doing right now. Is it weak and acting badly, or is it merely going through a normal intermediate decline, typically 8 to 12%? Is it doing just what it should be, considering the basic current conditions in the country? Or is it acting abnormally, strong or weak? To answer these and other vital questions, you'll want to learn and analyze the overall market correctly. And to do that, you must start at the most logical point, and that is the market direction. The market direction method that we discovered and developed many years ago is such a key element in successful investing that you'll want to reread this chapter several times until you understand and can apply it on a day-to-day basis for the rest of your investment life. If you learn to do this, well, you should never in the future find your investment portfolio down 30 to 50% or more in a bad bear market. The best way for you to determine the direction of a market is to look carefully at, follow, interpret, and understand the daily charts of 3 or 4 major general market averages, what their price and volume changes are doing on a day-to-day basis. This may sound intimidating at first, but with patience and practice, you'll soon be analyzing the market like a true pro. This is the most important lesson that you can learn if you want to stop losing and start winning. Are you ready to get smarter? Are your future peace of mind and financial independence worth some extra effort and determination on your part? Don't ever let anyone tell you you can't time the market. This is a giant myth passed on mainly by Wall Street, the media, and those who have never been able to do it. So they think it's impossible. We've heard from thousands of readers in this chapter and Investors Business Daily, the big picture column, who have learned how to do it. They took the time to read the rules and do their homework so that they were prepared and knew exactly what factors to look for. As a result, they had foresight and understanding to sell stocks and raise cash in March 2000 from November to 2007, January 2008, and June 2008, protecting much of the gains that they made during 1998 and 99. And in the strong 5-year bull market in the stocks that lasted from March 2003 to June 2008. The erroneous belief that you can't time the market, that it's simply impossible, that no one can do it, evolved more than 40 years ago after a few mutual fund managers tried to unsuccessfully. They had to both sell at exactly the right time and then get back into the market at exactly the right time. But because of their asset size problems and because they had no system, it took a number of weeks for them to believe the turn and finally re-enter the market. They relied on their personal judgment and feelings to determine the market finally hit a bottom and turned up for real. At the bottom, the news is all negative. So these managers, being human, hesitated to act. Their funds therefore lost some relative performance during that turnaround that frequently happen at market bottoms. For this reason, and despite the fact that twice in the 1950s, Jack Dreyfus successfully raised cash in his Dreyfus fund at start of a bear market, top management at most mutual funds impose rigid rules on money managers that require them to remain fully invested, 95 to 100% of their assets. This possibly fits well with the sound concept that mutual funds are truly long-term investments. Also, because funds are typically widely diversified, owning 100 or more stocks spread among the industries, in time, they will always recover when the market recovers. So owning them for 15 or 20 years has always been extremely rewarding in the past and should continue to be in the future. However, you, as an individual investor owning 5, 10, or 20 stocks, don't have a large size handicap. Some of your stocks can drop substantially and maybe never come back or take years to do so. Learning when when it's wise to raise cash is very important for you. So study and learn how to successfully use this technique to your advantage. Now, just before we go on, guys, I think we all know that, I take kind of a group of, market direction keys. We use Stan Weinstein's stage analysis a lot. I love the stage analysis. This one's going to go over some of the moving averages so we can understand the market direction. I don't think any of you are going to be new to this. If you are, you're more than welcome to ask questions. Title, I know that you're fairly new to our trading group, but if you're new to anything that we're doing here, just stop me, ask questions. It'll be good for the YouTube video. It'll be good for everyone, honestly. So no dumb questions here. So this is going to start with what is the general market. The general market is a term referring to the most commonly used market indexes. These broad indexes tell you the approximate strength or weaknesses each day overall trending activity can be done of your earliest indications of emergency trending. They include the Standard & Poor S&P 500, consisting of 500 companies. This index is a broader, more modern representation of the market action than the Dow. The NASDAQ Composite, the Dow Jones Industrial, and the NSE Composite. All these key indexes are shown in the Investor's Business Daily in large, easy-to-analyze charts, also featuring a moving average and an accumulation distribution rating for each index. We're going to skip over that portion. Why is skilled, careful market observation so important? A Harvard professor once asked his students to do a special report on fish. But let me see here. And they wrote their expositions, but after turning in their papers, the students were shocked when the professor tore them up and threw them in the wastebasket. When they asked him what was wrong with the reports, the professor said, if you want to learn anything about fish, sit in front of a fishbowl and look. And look at fish. Let me reread that because I butchered it. If you want to learn anything about fish, sit in front of a fishbowl and look at fish. He made his students sit and watch fish for hours. They then rewrote their assignment solely on their observations of the objects themselves. Being a student of the market is like being a student in a professor's class. If you want to learn anything about the market, you must observe and study the major indexes carefully. In doing so, you'll come to recognize when the daily market averages are changing at key turning points, such as major market tops and bottoms, and learn to capitalize on this with real knowledge and confidence. There is an important lesson here. To be highly accurate in any pursuit, you must observe and analyze the objects themselves carefully. If you want to know about tigers and need to watch tigers, not the weather, not the vegetation, and not other animals on the mountain. Years ago, when Lou Brock set his mind to breaking the baseball stolen base record, he had all the big league pictures photographed with high-speed film from the seats behind first base. Then he studied the film to learn what part of each pitcher's body moved first when he threw to first base. The pitcher was the object that Brock was trying to beat. So it was the pitchers themselves that he studied in great detail. In 2003, the Super Bowl of Tampa Bay Buccaneers were able to intercept 5 Oakland Raider passes by first studying and then concentrating on the eye movements and body language of Oakland's quarterback. They read where he was going to throw. Christopher Columbus didn't accept the conventional wisdom about the earth being flat because he himself had observed ships at sea departing over the horizon in a way that told him otherwise. The government uses wire traps, spy planes, unmanned drones, and satellite photos to observe and analyze objects that could threaten our security. That's how we discovered Soviet missiles in Cuba. It's the same with the stock market. To know which way it's going, you must observe and analyze the major general market indexes daily. Don't ever ask anyone, what do you think the market's going to do? Learn to accurately read what the market is actually doing each day when doing it. Isn't that kind of funny? It even says right here, guys, don't ever ask somebody, what do you think the market is going to do? And you guys will see it all the time in here. You guys will see it, in the chat room and stuff. And I'm not an asshole in any way. I always kind of lead them on to, well, what do you think is going to do? Because anytime you ask a question, it should be followed up with your thoughts and your opinions for two reasons. One, so it shows that you are trying to articulate and not be spoon-fed like a baby. And two, it also shows the answeree, or the person that you're trying to communicate with, at what level you are on in understanding the general market. If you say, I think the market's going to go up tomorrow because it's been down for a while, that's an opinion. But if you can articulate your thoughts and get it out there a little bit more, like perfect example, the way Dan Bob said, I think we're into resistance. I think that we're in resistance now, and I think we're going to pull back here and hopefully hold another, and not give it all back. But Dan articulated, and instead of saying, no, I think it's going to go higher, he said, I can see fear of missing out in the morning. Trump's announcement was actually late in the day. So with that being said, he has articulated on why he thinks the market's going to go higher, and it's a very valid reason. So when we articulate on things like that, we don't want to just ask somebody, what do you think the market's going to do tomorrow? Because nobody truly freaking knows. Nobody truly knows what's the market going to do tomorrow. But if you generally analyze and observe, you can find the proper levels that are in the market. Like we constantly go over, and we'll go really deep on Sunday of the market levels. But you can see right here is one of those. Right here is one of those levels. I would probably just draw it out right like this. So we're right here at this resistance. But I would draw it more of a bigger box here, because we have this area of resistance too. So it's a wide area of resistance here, and knowing that, observing it, analyzing it in real time, and seeing how the market reacts to these levels is very important. If we blow through this, guys, and then come back down and retest it, and it shows that this area is strong, that's a huge sign for me. If we pull back and create a new lower high and start to tread sideways, that's a huge sign for me. If we just pull right back down and hit a new low, these are all different. These are all going to mean different things. I'm going to analyze them differently. But right now we're wide and choppy, and you guys know I like it tight. The tighter the better off the market's going to be. With all this choppy and volatility, you have to be careful. It's only a day trader's market, so we're going to sit back, relax, wait for the setups, wait for the leaders in the market. Let's continue. The stages of a stock market cycle. The winning investor should understand how a normal business cycle unfolds and over what period of time. The investor should pay particular attention to recent cycles. There's no guarantee that just because cycles last 3 or 4 years in the past, that they'll last that long in the future. Bull and bear markets don't end easily. It usually takes 2 or 3 tricky pullbacks up or down to fake out or shake out the few remaining speculators. After everyone who could be run in or out has thrown in the towel, there isn't anyone left to take action in the same market direction, then the market will finally turn and begin a whole new trend. Most of this is crowd psychology constantly at work. Bear markets usually end while businesses is still in a downtrend. The reason is that the stocks are anticipating or discounting all economic and political and worldwide events many months in advance. The stock market is a leading economic indicator, not a coinciding or lagging indicator. In our government series of key economic indicators, the market is exceptionally perceptive, taking all events and basic conditions into account. It will react to what is taking place and what it can mean for the nation. The market is not controlled by Wall Street. Its actions is determined by millions of investors all across the country and thousands of large institutions, and is a conscious conclusion on whether it likes or doesn't like what is foreseen, such as what our government is doing or about to do, and what the consequences could be. Similarly, bull markets usually top out and turn down before a recession sets in. For this reason, looking at economic indicators is a poor way to determine when to buy or sell a stock and is not recommended. Yet some investment firms do this very thing. The predictions of many economists also leaves a lot to be desired. A few of our nation's presidents have had to learn this lesson the hard way. In the early 1983, for example, just as the economy was in its first few months of recovery, the head of President Reagan Council of Economic Advisors was concerned that the capital goods sector was not very strong. This was the first hint that this advisor might not be as sound as he should be. Had he understood historical trends, he would have seen that capital goods demand has never been strong in the early stages of a recovery. This was especially true in the first quarter of 1983, when the U.S. plants were operating at a low percentage of capacity. You should check earlier cycles to learn the sequence of industry groups, moves, and various stages. And guys, it's something that we do too. You know, we know what's cyclical, what's not cyclical, what should be rising, what shouldn't. We focused a lot too on this pullback. What's defensive? I know I learned on this pullback, and I wasn't aware on any of the other bear markets that I've been a part of, that insurance is a flight to safety. It's kind of like gold, like you've seen gold and consumer staples. These are flights to safety. And I learned that insurance was one of those. So we're always learning. You're always going to learn something new on a bear market and a bull market, or any day that you're here with this group, right? It says you should study the general market indexes each day. And if you guys have been with me long enough, you know I always start with the general indexes. I usually tend to focus on which one's doing the best, whether it's the QQQ or the S&P 500. For a short period of time in my stint on YouTube, we did look at the IWM. Aside from that, POS lagger, we do look at those indexes every time we get together because we want to know the market direction. If the market direction's down, we're hands off. If the market direction is trending above a 21-day moving average, you know we are looking, or we are already in some longs. And we're looking for those leaders because those leaders tend to move a lot faster than the market. And that's just what we're waiting for. So you should definitely study the general market indexes each day so you can understand. That's why I took this short, guys. That's why I shorted the market on this day, because we were just running into that 200-day moving average. And we just had no buying power. There was no volume in it. And the risk management to me was just there. It was right there. It took it at high a day, held on to this thing for quite some time. We made some killer money. And then once we got overextended here, and all I did was go back and study this. We've never been this far overextended. And I told you guys in the morning, I exited most of this short. And I'm going to be honest with you guys, of course there's there's some luck in this, right? I caught what I would consider the top. It wasn't a top tick, but I consider this a top. And because I noticed the exhaustion, and I got to play this until I seen capitulation and oversold conditions, and I exited. This is just simply being a part of the market and analyzing every single day, studying every single day, looking into charts, listening to other people analyze, excuse me, and then creating my own ideas and understanding to help me internalize this market. Just like each and every one of you can do if you aren't doing it already. Let me take this sweatshirt off. I'm getting pumped. All right, so let's go ahead and read. We're going to look at something a little bit darker, even though we just got a nice pop today and we got a nice rally. We do need to keep in mind that this could be a pop into resistance and we could continue to fail, okay? With that being said, I want to read to you about the prolonged 2-year bear market of 1973 and 1974. The combination of Watergate scandal and hearings of the 1974 oil embargo of OPEC made 1973 and 74 the worst stock market catastrophe up to the time since the 2933 depression. The Dow corrected 50%, but the average stock plummeted more than 70%. This was a big lesson for stockholders and was almost as severe as the 90% correction the average stock market showed from 1929 to 1933. However, in 1933, industrial production was only 56% of the 1929 level, and more than 13 million Americans were unemployed. Let me get a drink here. The peak unemployment rate in the 1930s was 25%. It remained in double digits throughout the entire decade and was 20% in 1939. The market was so demoralized in the prolonged 1973-74 bear market that most members on the floor of the New York Stock Exchange were afraid the exchange might not survive as a viable institution. This is why it's absolutely critical that you study the market averages and learn how to protect yourself against catastrophic losses for the sake of your health as well as your portfolio. You can learn to do this. Anyone can do it. If they get serious, apply themselves. Is your money important to you? A 33 drop requires a 50% rise to break even. Now, guys, I'm gonna say I have a really hard time understanding this. I was actually just thinking about this today, and I'll be the first to tell you when I don't know something, because I really try to, but I've heard this so many damn times. So I'm gonna read this. I'm gonna read through it one time and one time only. I'm not gonna stop to sit here and try and figure it out in front of you. But yes, somehow this is true. A 33% drop requires a 50% rise to break even. Let's read. The importance of knowing the direction of the general market cannot be overemphasized. If you have a 33% loss in a portfolio of stocks, you need a gain of 50% gain just to get your break-even point. If, for example, you allowed a 10,000 portfolio to drop to 66,666, a 33% decline, it has to rise 3,333 or 50% just to get you back to where you started. Well, that makes sense, because you're losing money to gain that same sum up. It's going to be a bigger proportion than the percentage of the overall. I mean, yeah, okay. In the 2007-2008 bear market, the S&P 500 fell more than 50%, meaning that a 100% rebound will be needed for the index to fully recover. And how easy it is for you to make 100%. Maybe it's time for you to learn what you're doing, adopt new rules and methods, and stop doing things that create 50% losses. This is another big reason, guys, why I say we don't marry stocks. Now, if you have an overall long-term investing account where you're going to get in and just forget about it, and it is truly for the long term, then go for it. But do keep in mind that if you're a swing trader like I generally am, just focusing on the momentum, we don't get in a stock and say, you know what, I love this stock. This is my kind of stock. I love everything. I'm marrying the stock. I'm going to hold on to the stock. Because that stock, if it fails, even if it gets back up to where you were, you're not making any money. First of all, your money's tied up in that stock. You're not getting that money out. You can't use that to make you money. It's in a stock that's downtrending. So just have your rules, and this here it makes a lot of sense. 33% decline. You need a 50% incline to make that money back just to hit break even. It's hard. It's harder to make 50% than it is to lose 30%. So keep that in mind. The myths about long-term investing and being fully invested. Many investors like to think of or at least describe themselves as long-term investors. Their strategy is to stay fully invested through thick and thin. Most institutions do the same thing, but such an inflexible approach can have tragic results, particularly for individual investors. Individuals and institutions alike may get away with standing pat through relatively mild 25% or less bear markets, but many bear markets are not mild. Some, such as the 73-74 or the 2000 and 2022 or 2007-2008, are downright devastating. The challenge always comes at the beginning when you start to sense an impending bear market. In most cases, you cannot project how bad economic conditions might be or how long those bad conditions could linger. The war in Vietnam, inflation, and tight money supply helped turn the 69-70 correction into a 2-year decline of 36.9%. Before that, bear markets averaged only 9 months and took the averages down 26%. Most stocks fall during a bear market, but not all of them recover. If you hold on during even a modest bear correction, you can get stuck with damaged merchandise that may never see its former highs. You definitely must learn to sell and raise at least some cash when the overall environment changes and your stocks are not working. And this is something that I've just naturally been good at. I think it's just because I've been following the same guys time and time again. When we do start to pull back, when we break that 21-day moving average, instead of holding on to your shit stocks that are breaking your moving averages or breaking those lows or hitting your stop losses, right? And you're not selling them for whatever reason, think of the pullback and stopping out as you're raising capital for a better stock. I've been in cash for quite some time. I've only deployed cash for a few days, day trading the pullbacks on this. But this whole time, I have been in cash and waiting and ready for the right time. And so far, there's just no real leadership out there to get me wanting to jump all in on anything. But I have enough deployable cash right now. And that's a hedge fund can't do that. Like you read here, they have to stay invested, 80 to 90% or whatever, whatever they have. We can get in and out as quick as we want. And I think we need to take full advantage of that. So the whole long-term investing thing, William O'Neill does not care for the long-term investing. He still thinks that you should have investing rules for the long term, and he thinks that you're just, I think, what did he say? Basically, you're lazy. You just say that so you can be lazy. Let's see, what time? It's 9:30. Okay, we're going to just do this one last one, and it's using stop loss orders. And of course, we can always carry on with this, but I don't want to read each and everything about the market direction. We'll leave some for another time, but I do want to point on this, guys. We're going to close on this. Using stop loss orders, okay? If you're new, if this is the first time, you're hearing this, we use stop loss orders, okay? Libby, if you could just mute your mic for just a second. I'm always about using stop loss orders. Now, I personally put a hard stop in, and usually my stop losses are either low of day, low of previous day, or low of an area that manages well with risk. A break of a low or a base, or yada yada yada. I have that set. I usually have a hard set stop until it gets too far from those stop losses. I'll usually cancel and then just keep an eye on my moving averages. And I always preach a stop loss. Whether you want a hard stop or you want a mental stop. If you can use a mental stop or a written stop, so it's not automatically getting you out, or do you stay true to those stops? Then, know your psychology before you do it. But in this, it goes on to saying, if you use stop loss orders or mentally recorded a sell price and act upon it, a market that is starting to top out will mechanically force you, robotic-like, out of many of your stocks. A stop loss order instructs the specialist in a stock on an exchange floor that once the stock has dropped to your specific price, the order become a market order and the stock will be sold out on the next transaction. It's usually better not to enter stop loss orders. In doing so, you and other similarly minded investors are showing your hand to the market maker, and at times they might drop the stock to shake out stop loss orders. Instead, watch your stocks closely and know ahead of time the exact price at which you will immediately sell to cut a loss. However, some people travel a lot and aren't able to watch their stocks closely, and others have a hard time making sell decisions and getting out when they are losing. In such cases, stop losses orders help compensate for distance and indecisiveness. If you use a stop loss order, remember to cancel it if you change your mind and sell a stock before blah, 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 blah. We don't want to get you confused with shorting. But I always recommend using a stop loss, whether it is a hard stop or a mental stop. I like hard stops. So that way, if I go unconscious tonight, I know that I'm still not shorting XYZ stock, right? Or if I am shorting it and my stop loss doesn't get hit, when I wake up, I'm probably going to be filthy rich, right? So I always use a hard stop, quite literally, because if I were to be incapacitated for any reason, everything's fine. My business is going to continue to run properly, okay? So that is why I use hard stop losses, and usually where my stop losses are tell me that we are not in a momentum stock. If I'm looking at a stock and I say, I want it to break out of this area, and it breaks out but then comes back down, all the way back down here and stops me out, I'm not in a momentum breakout stock. I'm in a stock that had a fake breakout. And I'm a momentum trader. So I like to use those tight stop losses. I like to use hard stops. And some people think my stops are too tight, and that's totally fine. You can widen your stop as wide as you want to go. But I like a tight risk, and I like to know right away if I'm right or wrong. And that's the only reason why I do it. So before I take off, do we have any questions? That was Chapter 9 and how to make money in stocks. I will be uploading this to YouTube. If you are watching this on YouTube now, thank you. Thank you for making it all the way to the end of the video. I hope you had an awesome time. Join the Discord, join our awesome community, and hit that subscribe button for me.